From New York City for our viewers worldwide, I'm Jonathan Ferrer with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, Republicans take another step towards cutting taxes, but corporations may have to wait until 2019 for 20%. Cracks appear in credit, investors get indigestion. ETFs tracking junk debt bonds fall the most since August. And is there a message in the Treasury market? The yield curve is near the flattest level in a decade. We begin with a big issue: junk bond pain spreads.
High yield's a difficult market, I think, at the moment anyway, isn't it?
The question is this a couple of isolated cases, or is this the start of something broader? Right now, it still seems more isolated.
Clearly, the tax package right now will create winners and losers in the credit market.
Tax reform has to happen. So if it doesn't happen, that gets ugly, stock markets get ugly, everything gets ugly very, very fast.
It's no longer a green light for credit markets. In fact, it's more yellow. Clearly, there are still some companies with decent fundamentals, but there is a lot of sectors now, or at least more sectors, under pressure.
You're not getting paid an awful lot for default risk. So as an investor, you have to be very, very careful buying the quality. But, you know, these days where markets roll over, it feels volatility needs to rise, and maybe that's all we're just seeing.
My concern is, what if the market starts to price real optimism around an ultimate tax deal, and that 10-year goes to 260? That could be interesting. That's a genuine competitor to the credit market, and that's where I think the bleed could be more systemic.
The 800-pound gorilla, which eventually we're all going to have to question, is whether or not this buildup in corporate leverage, which we've seen over the past 3 or 4 years, is that sustainable, or does that lead to something less benign?
To weigh in, we've got a full house around a table in New York City today. Joining me is Henry Peabody, Portfolio Manager at Eaton Vance Management, Subadra Rajappa, Head of US Rate Strategy at Societe Generale, and Ashok Bhatia, Senior Portfolio Manager of Multi-Sector Fixed Income at Neuberger Berman. Ashok, let's begin with you. The situation in credit. We've seen this movie twice already this year. In the spring, again in August, and now as we approach the December and the end of the year. Are we going to see what we saw earlier in the year? We roll over, and then we just roll back up again?
Don't think so. I think this one's a little different. Best guess is the tights for credit spreads are probably in for the year. And the reason is there's two things that are a little different about this sell-off. One is there's some fundamental deterioration in earnings that have come out, whether it's in some of the telecom names, some of the retail names, some of the pharmaceutical names, IG, high yield. There's some real disappointments, and it's going to be hard to re-rate these credits near term. And I think the second thing, and this is a critical part too, is tax reform is not live. We're seeing bills. We're seeing a House bill. We're seeing a Senate bill. And these are creating some winners, and they're going to create some losers. And some of the losers are going to be in things as varied as hospital bonds in the municipal market, potentially, to cruise ship securities. And we're starting to figure that out. And as we start to focus on the winners and the losers, it's just going to be something that's a little bit of an overhang, we think, for credit.
Yeah. Henry, it was something that struck me as well. The same thing. It started out as almost a stock-specific story, a company-specific story, and then it bleeds through the sector. So we take, say, Sprint. The deal collapses and it goes into Sprint. Then it goes into the telecoms and it spreads into healthcare. And those were the two leading declining sectors. Is it sector-specific for you, or does this become an asset class problem?
I completely agree. I think there's some sector-specific concerns and fundamental concerns. But from a valuation standpoint, and that's really the starting point of this, I think some of the concern really is that we've baked into a negative correlation story between equities and rates, and pile in the carry and low volatility. And if you start to get a whiff that equities are going to sell off with rates, it becomes a big question of our models and how we think about credit and risk and rates. And that's what's happened the past couple of days. So do we have a larger unwind? It's very possible from some pretty stretched valuations.
Subadra, do you see the valuation problem as well?
Yeah, no, I think this is actually an intended consequence of quantitative easing, right? Typically, in an environment where yields are very, very low, investors go further and further out the risk spectrum in order to get returns. And what happens as a consequence of that is, over time, you start having this risk build up in the system. The question ultimately is it's about risk versus reward, in very, very simple terms. And to me, I feel like we might be at a tipping point where the risk might outweigh the reward.
Well, Ashok, I feel like we've been talking about that for such a long time, though. I could ask any guest around this table for the best part of this year, are you being compensated for the risk you're assuming in the market? They'd say no, but there is no alternative. You could pick out the Tesla bond issue in August and say to people, is that priced properly? They'd say no, but they bought it anywhere, and look where it's trading now. Why is it different now?
Well, I think, first of all, take a little bit of a step back.
Sure.
Right? We're in a positive growth environment. We're in a synchronized growth environment. Hard to see that changing. That's fundamentally a support for credit. You know, spreads may be tight. We may have a blip. We may have seen the tights, you know, near term for the year. But does that mean we're about to have a 2008-like experience? Well, we don't think so. We think this is going to be a little bit more of range trading. But the drivers of a big default cycle in U.S. credit, they're not there right now.
But something you said, the economy's doing well, and I just wonder whether credit is somewhat divorced from the economy anyway, given where the rest of the market has been trading well ahead of an economy recovering. Look at what's happened in Europe. We were incredibly tight before we came into this year, before the data got better. And we had a guest on earlier this week who said, rather counterintuitively, maybe as the taxes come through, as the economy gets better, as Treasury yields back up, you're not going to have a good environment for credit. Maybe you have the opposite. What do you say back to that counterintuitive argument?
I'd say, you know, it's a question of degree, right? If we have a 30 basis, let's just say we have a 30 basis point back up in Treasury yields and a little bit of widening of credit, and we're still sitting here with the same U.S. growth environment, which is a reasonable enough hypothesis. What we think we'll see continued foreign demand. As you know, one of the big stories, Jonathan, in credit has been the demand from Japan, from overseas, from Asia. You know, our sense is that client base would view that kind of a backup as an interesting place, a time to invest. Again, assuming that the economy is sort of still at this kind of level, which is kind of our base case.
Henry, you see that support coming in as well?
Hey, probably. I think there's a lot of conversation about it. But one of the things also to think about is the mammoth flow into passive and index-based products. And I think that that's providing support for the Teslas of the world and the Netflixes of the world that come at some pretty pricey levels. The question then becomes, what happens when there's a call on liquidity in the broad market? And we see it extending into private credit and private equity. So that call on liquidity is going to be those public markets. So what happens then? And I think we need to be cognizant of the risk in those broad markets and be selective.
Henry, have you seen any of that this week? Any evidence of almost some forced selling of things that are the most liquid and they're the things you can sell?
That actually is what we have not been seeing. And I think the point here is it's fundamental driven. So watch for these cracks to spread into a more broad-based call on liquidity. So far hasn't happened, but really that's how these things get started. They don't start in the most obvious of fashions. You can never see the catalyst for a negative move ahead of time and pinpoint it. It's when you least expect it. And so right now, there's a great deal of positive news. Your point about the economy is well taken, but what about Saudi Arabia? What about the risks in the Middle East? There's a lot of risk in the market right now, and we're not compensated for it.
Subadra, something that struck me this week that I thought was really different, and it happened in Thursday's session. A risk-off environment, equity soft, credit soft, bunds on offer. Yep. German bund yields higher, and I was trying to figure out what was going on. Did you figure out what was happening?
Absolutely. I think there was it really comes down to central bank communication, right? You had a very, very dovish ECB come out a few weeks ago at the meeting. The market overreacted. You saw a rally in bonds after they announced a tapering of asset purchases, and you had ECB official Benoit Cœuré come in and say that the market's very, very complacent. And lo and behold, you started seeing the sell-off in bonds because, now we have an environment where, the European Union is having its best growth in almost 20 years. And it feels in that environment that bond yields are actually, very, very low, and they have to actually reprice higher.
So here's a question for you, Ashok, to wrap up this segment. Do you see more risk in high yield or more risk in the supposed risk-free asset like bonds, like treasuries?
Well, if you don't mind, I'll pivot on that quickly. We see risk, focused in, certain IG sectors. We see risk focused in some of the interest rate sensitive BB high yield sectors at the margin. But again, don't want to over exaggerate these risks. The issue with the sovereign bonds issue is you got Japan pinning 10-year bonds at zero, and you have European rates at negative, and those are two big gravitational pulls onto treasuries.
Yeah.
And could we get up to 270 and 10s? Absolutely. Is it a bigger story than that? We don't see that right now.
Guys, solid conversation. Everyone stick sticking with me. Henry Peabody from Eaton Vance Management, Subadra Rajappa from Societe Generale, and Ashok Bhatia from Neuberger Berman. Coming up on the programme, the auction block. Last week, Apple's Tim Cook opened the doors for the sale of the iPhone 10. This week, he was selling billions of bonds. High-grade issuers shrugging off broader market weakness. This is Bloomberg Real Yield. From New York City for our viewers worldwide, I'm Jonathan Ferro. This is Bloomberg Real Yield. I'd like to head to the auction block now. While NRG Energy pulled their auction this week, high-grade issuers very much forged ahead. We begin with Apple. The iPhone maker sold $7 billion of unsecured bonds in 6 parts as it looks to fund stock buybacks and dividends. Apple has been the second most active US non-financial issuer of debt this year, just behind AT&T. Plus, you had UPS with a more than $5 billion offering. The delivery company sold debt across 7 tranches, with the 30-year portion yielding 1 percentage point more than Treasuries. And the US Treasury sold $23 billion of 10-year notes at a yield of 2.314%. The bid-to-cover ratio 248. The demand and the yield at the lowest levels since September. Still with me around the table, Henry Peabody from Eaton Vance Management, Subadra Rajappa from Societe Generale, and Ashok Bhatia from Neuberger Berman. Let's bring up the chart of the week for me and for many people, the chart of the year. And it's a chart that many people thought would get steeper. And it hasn't, Subadra. It has got a whole lot flatter. And it's the yield curve. You can take 2s, 10s, 5s, 30s, pick your place on a curve, and it looks something like this. This is the 2s, 10s. A bounce over the last couple of days to end the week, but certainly the trend is pretty clear. What's the signal, if anything, the message that comes out of that chart right now?
Well, you have to look at the yield curve within the context of the current market environment. You have some technical factors like the Treasury's refunding announcement last week, where they're going to be focusing more on front-end issuance. That puts some pressure on the back end of the curve, rallying on the back end of the curve after the refunding announcement. But you also have some longer-term secular trends that are keeping bond yields in the very long end of the curve in check. I mean, for instance, demographics is an important consideration. You also have the savings glut and tremendous amounts of demand coming from overseas accounts for the long end of the Treasury curve. So if you put all of this within the context, I mean, yes, the curve is flat. At some point, it's going to become a concern for the Fed. If the curve does get to be too flat, it's going to become a concern for the Fed for 2 reasons. One, it's going to really hurt bank profitability, and 2, it's as an investor, if you look out the curve, you're just not getting adequately compensated for taking risk further out the curve. So
we've got this classic bear flattener in the Treasury market, Henry, and I wonder whether it's a message for the Fed to slow down. Does that have to be their takeaway?
No, I don't think so. In my guess, the curve will probably end up shifting higher, and that will be a source of volatility. One of the most underappreciated risks in the market today is inflation, and not ready to give up on the concept that supply and demand of labor will eventually push prices higher. I think we expect things to happen a lot sooner than they actually do. So I think we probably see that move higher. But your point about the curve, whether it's funds, 2s, 10s, it's certainly trading as if the curve thinks the Fed is incredibly raising rates. But they are. And so to me, the main signal from that curve you just showed is watch out. There's too much risk, there's too much capital that's trapped in the long end of the curve that's been there reaching for yield through duration, that's going to be in a bad spot.
Is it a crowded trade?
Absolutely.
What's the evidence of that?
I think it's what we see is we've had a history dating back since the 70s, really beforehand. Since the inception of the Bloomberg, government index, it's returned something like 7% annually with a 5% vol. That's supposed to be a risk-free asset. Now you've got those numbers that are put into modern portfolio theory models. You have QE, you have LDI, you have passive, you have a series of price-insensitive buyers coming into the market that push prices to where they ought not belong. So when a bond is bought by virtue of its spot in a model, not for a total return opportunity, it says to me that it's a little bit long in the tooth.
Ashok, I feel like we've been talking about this, though, for a while as well.
Yeah.
And I was having a discussion earlier on Bloomberg TV about the cracks in credit, and then a headline dropped, and it was from the Spanish Treasury. 2066, they're going to be issuing 50-year debt next week. Is the market going to soak that up in a big, big way? I think many people would say yes, it will.
Yeah, probably. I think that there remains a demand for long-duration sovereign debt in this environment, and it's global. As we were talking about earlier, it's partly related to what Japanese and the European bond curve is occurring. But I think the way we're thinking about it is the Fed's hiking, and the Fed's hiking in an environment where inflation is at best unclear, and that is sort of big picture a recipe for curve flattening. And the curve is likely to change. We have a potential it will change next year if the Fed signals it's sort of done and it's reached a terminal point, or inflation starts ticking higher, and we start to believe that the Fed maybe will accommodate it a little bit. And those will be the two signals for, we think a more structural shift in the curve. But that is, your chart, it's a trend, and it doesn't look like it's about to break.
Subadra, would you concede that the moves by the Federal Reserve have taken something away from future growth, have taken something away from inflation expectations, and have driven actually the long end lower?
Yeah, no, absolutely. I think that you have an environment where inflation is relatively benign, and you have an environment where the global stock effect of central bank holdings is very, very large and has grown tremendously over the last 2 or 3 years. So you have, it just really takes the volatility out of the system. And once in an environment where interest rates are low, volatility is low, and returns are also low, you tend to have this sort of flattening of the curve.
So Ashok, I'm thinking about how to express this in the market. What's the actionable trade? Because if you've positioned for a steepener this year, it's been really, really painful. If you don't want to do that, but you see the market developing in the way you anticipate, what is the best way to anticipate that and to express it?
Well, I think it's still to be, in positions that will benefit from continued curve flattening. But it is the time to start thinking about shorter duration fixed income and shorter duration fixed income yields. I mean, we've got the 10-year at 230, right? This is not a 10-year at 230 with the funds rate at 0 anymore. This is 230 against a 125 funds rate. Investors are, you have to give up less income to come into a shorter duration strategy. And it's something we see clients doing. And I think that's a trend that's going to continue. And at the margin, it's sort of how you react to what's going on.
Guys, it's great to have you with me. You're sticking with me. Henry Peabody from Eaton Vance Management, Subadra Rajappa from Societe Generale, and Ashok Bhatia from Neuberger Berman. Let's get a check on where bonds have been this week, shall we? Treasuries, 2s, 10s, 30s. Yields up by 4 basis points at the front end, higher at the long end by about 7 basis points. So whilst we've been talking about a flatter curve through the week to end the week, you end up with a little bit of a steeper curve to finish the week. Still ahead on this program, the final spread, the week ahead, featuring the continuation of President Trump's trip to Asia. This is Bloomberg Real Yield. From New York City for our audience worldwide, this is Bloomberg Real Yield. I'm Jonathan Ferro. It's time now for the final spread. Coming up over the next week, the President of the United States, President Trump, continuing his first official trip to Asia, participating in the US-ASEAN summit over in the Philippines. Plus, you have Draghi, Yellen, Carney and Kuroda all on stage together at the ECB conference. US economic data, which includes CPI and earnings from Walmart as well. With me around the table, Henry Peabody from Eaton Vance Management, Subadra Rajappa from Societe Generale, and Ashok Bhatia from Neuberger Berman. Subadra, earlier this year, it felt like these guys were all on the same page. Some of them got together in Sintra, Portugal for the last ECB conference, and they all came out a little bit more hawkish than maybe some people expected. Is this coordinated, or is that just market chatter that doesn't really count for much?
I don't believe that this is coordinated. I think this was what was in the schedule. It's going to be a conference about communication and communication strategies. And communication's really been a struggle. I mean, if you look back in the last 2 decades, we've seen such an evolution of the communication strategy of the Fed, between Greenspan, Bernanke, as well as Yellen. And, the market tends to overreact sometimes to even small things that they say. We saw a large sell-off after the taper tantrum in 2013 when Ben Bernanke spoke in Jackson Hole, and we saw recently that the market, the bond market sold off quite dramatically after Draghi's comments, President Draghi's comments at Sintra. So I think communication is more art than science, and that's something that needs a lot of work.
Henry, why do you think they're struggling to communicate so much?
No, I think that there are a great number of constituencies who are looking for different messages, and it's a challenging role. You're talking about every market's hanging on your every word. I frankly think they're not doing as awful a job as you might say. I think the Yellen Fed has done a pretty good job of communicating its intention to roll off the balance sheet. I think the ECB, there are a lot of expectations about what the order of operations would be, and they've clarified that to a greater extent. And that tells us that the ECB is probably about a year or two behind the U.S., and that's why we're seeing this growth spurt, and that's why we're going to see two of the largest price-insensitive buyers of government bonds walk away slowly from the market, which fits in with that Bund move. So it says to me that, watch out for rates, just to harp on that topic, really.
How responsive, Ashok, do you think they'll be to the market moves that we've seen in the last week? If credit continues to fracture, we've got another pulled deal today. Canyon Resource just pulled a deal, so that's the second energy deal pulled this week. If we go into next week and credit's still looking fragile and these guys take center stage, are they sensitive to what's happening in the debt market?
Don't think so.
Why not?
I think these moves are still, in the grand scheme of things, they're a blip. And I do not think, the Fed, the ECB, BOJ, they're going to be looking at the real economy. They'll be thinking about whether or not these moves are going to filter into the real economy and slow growth. And I think it's premature to have that view. And I think the central banks will view this as we're on a path for the Fed to hike in December, and we're on a balance sheet unwind. And what's happened so far this week, not sufficient to change it.
Henry, your view on that?
I completely agree. And you take a long-term chart of spreads, it's really just a small hook at a very low level. And admittedly, there are some sectors that have come under pressure, whether it be generic pricing or balance sheet issues in some of the telecoms. But this isn't a widespread issue by any stretch of the imagination yet. It's also worth talking about the fact that leverage is extended. And we are seeing the tail end of a credit cycle. Now we can extend that with growth, but you see a deal like that be pulled, and I haven't looked at the details, but it's something that's to be expected at some point in this cycle. There have been deal after deal that's come through, and you've seen supply increase dramatically. One of the things we like to think about is how when bankers sell something, they know that there's demand for it. Bankers are not in the business of having deals fall apart, and we're just starting to see it. So watch in a couple of years where bankers have been able to get deals done, and that's when you want to buy it.
Guys, it's been great to have you with me around the table. Thank you very much for joining me. To Henry Peabody from Eaton Vance Management, to Subadra Rajappa from Societe Generale, and to Ashok Bhatia from Neuberger Berman, thank you very much. That does it for us from New York. We'll see you next Friday at 12:30 New York time, 5:30 in London. This is Bloomberg Real Yield.